A couple of words for you. Death spiral, oil-mageddon. My next guest using those terms earlier this month to predict where the global economy could be headed. Citigroup Strategist Jonathan Stubbs is with us live right now from London. Jonathan, good to see you. Thanks very much for joining us.
Morning. Thanks for having me.
Connect the dots for us of oil and equities and the economy. We're talking all about the relationship and why oil it really predicts or dictates what equities are doing from day to day.
Well, there are three very dangerous feedback loops at the moment for the global economy and global markets. One of them is the relationship between liquidity in markets and financial conditions. One is between sort of disinflation pressures and central bank credibility, and then you have oil-mageddon, where we have strong US dollar, we have weak commodity prices feeding into weak global trade, petrodollar concerns feeding into weak EM growth and feeding back into sort of weaker DM growth. So that if uninterrupted, is the death spiral, and there are three of them that need to be broken as we go through this year and into next year.
So Jonathan, death spiral is a very dramatic term, and you know, I don't see a death spiral. I see, how about this, a little less dramatic, slower global growth. Is that kind of what you're saying, but a little bit sexier?
That is the conclusion of our report and our thoughts, yes. So
death spiral means slower economic growth.
Well, death spiral is what we have been observing in equity markets, especially outside the US. In European markets, we've seen share prices 30% off their tops.
Right.
We saw 20% down in a couple of months. Same in Japan. So that's what financial markets have been reflecting. But the real world, as you suggest, is slightly different. We're seeing an ongoing deterioration in the global growth story. We're seeing this slowdown continuing. But our conclusion is that we do not have a death spiral in the real economy, and if this year we go to an environment where the dollar is less strong and oil prices stabilizes, which is our base case, then we actually break these death spirals.
So let's go to your base case. So in this death spiral scenario you're talking about, or slower GDP growth, whatever we call it, what is your view? And I realize you have, most people don't realize this, that the economists have best and worst case, right? So what is your view on what intervention monetary policy or monetary agencies are going to have in terms of positively impacting share prices, even if slower GDP growth exists? Don't you think that monetary policies will continue to be incredibly interventionist?
Well, I'm an equity strategist, and I work very closely with my economic colleagues at Citi, and we have for the last 5-6 years lent very heavily, obviously, on sort of central bank actions, and there's been this central bank liquidity put globally, which the Fed has been a large part of for a large number of those years. Well, this is the key debate. Global share prices and risk assets have been supported both by this liquidity put, but also this non-recessionary world. Both of those are under pressure right now. Central bank credibility has been sort of shot to pieces, especially here in Europe. And what is important now is that central banks fight to try and regain some of that credibility. In Europe, that's going to kickstart again in March at the next ECB meeting, where we expect to see Draghi announcing further increases to their attempts to try and rebuild credibility. Yeah,
one of the issues, Dagan, is the fact that these guys got it all wrong. I mean, the Federal Reserve waited way too long to raise interest rates. When they did raise interest rates, we were close to recession.
Right, and this kind of goes against what you were saying, but have investors completely lost faith in all central banks to do what would help the economy and to act with some decent timing?
So let me ask you this. If the central banks have lost credibility, why is it if Janet Yellen tomorrow gives a speech saying they're going to keep rates low for the rest of the year, will the stock market go up 500 points?
The stock market in Japan didn't go up when the Bank of Japan went negative.
I don't know if it would go up,
you don't
the stock market. I don't know. But you're asking somebody who thought Donald Trump's campaign would be over at the end of the summer.
Yeah. Jonathan, would you be putting money to work in equities right here?
I mean, a key sort of part of that is, what's priced in at these levels. And you take European shares as an example. You go back 20 years and you map share prices onto realised earnings or realised dividends. They track each other pretty quickly.
Right. So what's the answer then?
One quick. Well, the current share price move we've seen is effectively 20–25% below trailing earnings and trailing dividends. So we're already pricing in a significant recession. So to be bearish, and to turn the question around, to be bearish and to be selling here fundamentally, you need to believe that the world's going to experience a significant and synchronized global recession.
So if it's not,
that's the case.
So
then
yes,
you are
to buy
putting money to work
European equities.
So in other words, the answer is you are going to be putting money into equities because valuations look good to you then.
You are, but you have to recognise that that is an investment decision rather than a trading decision. We can see a lot of volatility around various central bank actions and other events, other political risks. Brexit here is a big risk in Europe as well.
Sure.
So you have to tread very carefully in the near term, but we do see the drawdown that we've seen in share prices as an opportunity as we look towards the end of this year.
Jonathan, thanks so much.